So this is the solutions video for the law questions from math class 6. All right, so question number 12, we've seen this one before in one of the previous sections. So just because, we have a question in one section doesn't mean it might not apply to a different one. So for this one here, this is about all of the elements that are considered in determining appropriate rates of interest on loans. So this is talking about that IYR percentage. So what is a lender going to look at in order to decide how much to charge you? So are they going to give you the best rate possible, or are they going to bump that rate up a little bit depending on what they find? So the answer for this one is all of the above, because the lender will look at your credit rating. So if you have a low credit rating, if you have a poor credit history, they can see that you've had late payments, missed payments, then they're going to consider you to be a little bit higher risk, and they may bump up that IYR. The second one is the type of property that's used for security. So different types of properties, different uses for properties, different zonings on properties, they all pose different risks to the lender. So if you're purchasing a property for your main residence, so that is going to be the place where you live, then that's a pretty low risk as far as property use. You want a roof over your head, so chances are you're not going to default on that mortgage because then you won't have a place to live. But for instance, if you were to be purchasing a property that's considered to be recreational, so you're not going to live there all the time, you're only going to use it for a few months or a few weeks out of the year, there's no ability for it to generate any income for you to help you manage that mortgage payment, then that would be considered to be a little bit higher risk for the lender, and they may decide to bump up your IYR as a result of that. The third one is something that we've heard about and talked about quite a bit already. So this is the amount of administrative work, so how nitpicky the loan is. And if it's really high administration, if there's a lot of a high degree of administrative work that's required to maintain the loan and even to get it set up, then the lender might bump up that IYR for you again. So depending on all of these things and a few other criteria, and that will determine what IYR the lender is going to charge you and put into your contract. Okay, so this question is talking about pre-approved mortgages. So this is part of the pre-approval process. So when you were doing your lesson video for math class 6, there were two constraints that the lender would look at. So it would be the property itself. So they would look at the property, right? The use, the lending value for that property, all that kind of stuff. And they would also look at the person. So they would look at your credit rating, your income, your credit history, what kinds of other loans you already have out, whether you have a student loan or a car loan, all of that kind of stuff. So the pre-approval part is talking about the person side, right? The income side of things. We're not talking about this one. Right now we're talking about before you go shopping, the lender is going to scrutinize you, going to look at all of these different things to decide whether they want to actually lend money to you in the first place. So that's what this pre-approval is referring to. So in your answer choices, the correct answer is that it's based on the borrower's current financial situation. So like I was saying, it's based on your income, right? And how do we figure that out? With our two formulas, right? Our PIG minus tax formula, or if we're looking at a commercial, it's going to be our PNOID formula. Okay, so we're going to find the payment that then lets us find the PV, right? How much we can borrow based on that payment that we've calculated from a person's income or business's income. Okay, so it's based on the current financial situation and a satisfactory credit review. So they're going to look at your credit rating and see whether you've got late payments or missed payments, all that kind of stuff. Number one is false, because when you do this pre-approval, so once you go through this whole process, usually you have a guarantee that you have in writing from the lender that they're going to give you a certain rate for a specific period of time. We wish it were 365 days, but it isn't. Usually it's 30 to 60 days, okay? It depends on a lot of different things. It depends on what the market's doing. It depends on what mortgage rates are doing. It really depends on what the lender's preference is for that pre-approval process, but typically it can be anywhere between 30 to 60 days. The number two says it calculates the minimum loan that the borrower qualifies for. That's false, because it calculates the maximum loan. So you remember how these questions in math class 6 are worded, how they're phrased? It says, what is the maximum that the borrower will get from the bank? And so we want to find the highest amount, the most amount that the lender is willing to give. So that's going to be the least, but it's going to find the maximum loan amount. So minimum is the incorrect word in that statement. And it's not based on a formula by the Fair Isaac Corporation. It's based on these formulas. So the PIG minus tax, the PNOID formula, that's what lets us know what's going on with this person. The Fair Isaac Corporation is actually it provides the formula for your credit scores. So which you guys don't calculate, so you don't need to worry about that, but that's what they're talking about when they reference that Fair Isaac Corporation. Okay, so number 69 This one, again, is about the residential borrower qualification process. So this is both sides that they're talking about in this question and all of these answer choices. So remember, we had the lender was going to look at the property itself, right, the lending value of that property, and they were going to apply that loan to value ratio on there. And then, like we just talked about in the previous question, we're going to look at the person's income, their credit rating, right, their credit score, the credit history, all of that kind of stuff. And then we are going to use those payment formulas with the income, your gross debt service ratio, minus your tax, and if you were doing a commercial, it would be NOI divided by your DCR. Okay, so both of these are mentioned in this question and the answer choices. So you see that in C, it says analysis of the real property that's pledged as security, so that's this side here. The analysis of the applicant's credit report, so that's this side here. The evaluation of the applicant's ability to meet the terms of the mortgage and the amount of their income, that's this side here. And the collection about the information about the borrower and the property, so that's mentioning both sides at the same time in the same sentence. So B is what we call a credit analysis. So the credit report gives you all of the facts about that applicant, but then you need to do an analysis of those facts in order to interpret the data. So that's what's happening in B. Like we said, we're going to use the formulas that we've got going on for both of these sides, right, for both of these criteria, constraints is what we call them. And then this is the credit report here. And the analysis of the credit report, again, is talking about the credit analysis. So it's just a few ways to say all of the same stuff, really. That's why the correct answer is all of the above. Okay, number 178 says, lenders who are attempting to ration mortgage funds could do what? So you have to understand what the word ration means before you can even answer the question. So ration means to limit, okay? So what were we doing when we did all of our math class 6 questions? We were using all of those formula that we just talked about, right? For both sides, we're using those formula to decide how much the lender would be willing to give that borrower. And remember, we wanted the choice between the two. If we had a dollar amount that we calculated between the two for the M and the PV amounts, we would always choose the lesser out of the two. And why was that? Why did we choose the lesser of the two? Because that was the lowest risk for the lender. Okay, so the least amount out of the PV and the M is the one that's the answer for all of those questions. So how can a lender, how can they limit mortgage funds? How can they lower the amount of mortgage funds that they give? Well, we have to look at the formula that we're given. So remember, we had our M formula and we had our payments formula for the residential, and then we have our payment formula for the commercial. And so I know that usually we just substitute NOI with I, but I wrote it out in full just so that you can see the difference between. And so for both of these, so for all of these, the percentages, the ratios are the things that actually limit the amount of funds that the lender would give. Because as I lower the LTV percentage, as I lower that loan to value ratio, I lower my M. As I lower my gross debt service ratio, I lower my payment. And for this one, because there's a division sign here, as I raise my DCR, as I increase my DCR, I lower my payment. So this here, that's your mortgage funds, right? That's the money that's being given by the bank that they're going to give. When we find our payments for these ones, what do we do with the payment? Well, we use it to find the PV. And so the PV is also the amount of the mortgage funds. So you can see that if we limit those percentages, then we can limit the M and the payment, which will then limit the PV for the payment formula. Now, a lot of people say, well, why can't we limit the tax? Well, because the taxes are set by the government. You can't change those. The borrower is going to owe those taxes. You can't lower them, or else they might not be able to pay them. The NOI and the I is the income of the borrower. So you have to use what they're earning in order to do the calculation. You can't just lower their income because that's not true. If they're making $100,000 a year, you have to use $100,000 a year in your calculation. And the lending value is what the appraiser will go in and come up with as a value for that property. So the lender can't just decide that they're going to lower the lending value. The lending value is the lending value. That is what the appraiser is saying that anybody that's going to come and purchase would be willing to pay. So the lender is stuck with limiting all of these. These are the ways that they eventually limit that M and that PV amount, okay? So if you look at your answer choices, the correct answer, the only possible correct answer is that they decrease their gross debt service ratio. So decreasing the interest rate might make it a little bit easier for the borrower to make the payments, but it means that it's reducing reducing the yield, reducing the earnings for that lender, and they don't want to sacrifice earnings to lower the risk. They want to earn as much as they can and still minimize the risk as much as possible. So that is not a correct answer choice. And in fact, if you decrease the interest rate on a mortgage, it actually will increase the PV. It'll increase the amount that you will give. So for two reasons, that answer choice is wrong. Number 3 says to increase your maximum loan to value ratio. And we've seen here that we have to decrease it in order to decrease M. So you wouldn't increase the loan to value ratio, because if you increase the loan to value ratio, that's going to increase the mortgage amount that you're willing to give as the lender. And then number 4 says to increase the maximum amortization period that's available. So instead of changing one of these or changing the IYR, they're now suggesting to change the amort period on a mortgage loan. And that is not true, because again, this is actually going to increase the PV, because the borrower has longer to pay off both the interest and the principal when you increase from an amortization of 20 years to 25 years. Okay, so if you don't believe that that's true, if something in your brain is saying, no, I don't think that that's the case, I think it would actually lower it, then how could you prove that? Well, you do the math, right? That's the best thing about proving math principles, is you can actually do math to prove that what you're thinking is true or not. So what I've got here is a question done, and you can solve these in your calculator. You can pause the video and solve them in the calculator. I just did it this way to save a little bit of time, but what I've done is I've started with a J1 equals 4 and a payment frequency of 1. And I've taken this information here with a payment of $15,000 per year and our amortization of 20 years or 25 years. And when you plug in all of this information using 20 years, you get $203,854 and some pennies. When you solve that again and you plug in the 25 years instead, you get $234,331 and some pennies. So you see that when you increase the amortization, you actually increase the amount of that PV, because the borrower has longer to pay off both the interest and the principal. So they have the ability to borrow a little bit more if you lengthen that amortization out. Okay, so that's the best way to prove that what you're thinking is true or not, is to actually just get a question, maybe take an example from your previous homework or a previous question on your mock exam or your exam, and you use the answer that you already got for that question to compare to the new one that you would get if you changed that one item. In this case, it would be amortization. So the best way to prove whether it's true or not is to do the math. Okay, number 188 says with respect to an insured mortgage loan. So that's the key phrase here. We're talking about an insured mortgage loan, and it's asking for which one of the statements being false. So number 4 is false. So when you have an insured mortgage loan, the insurance is actually paid for by the borrower. So the borrower actually pays for the insurance policy that will benefit the lender. So this default insurance actually benefits the lender, because it guarantees that the lender will recover their capital if the borrower happens to default. So the borrower stops making payments and they have to go into the foreclosure process, then maybe this is a way that they can recover some of their capital that the borrower hasn't paid back. Now, the borrower doesn't have to pay for the premium in a lump sum. They can just add it to the mortgage amount, right, as a bonus on that mortgage, and then they'll pay interest on it. So most people do this because premiums can be, several $1,000s or more depending on how much the property is. Okay, so numbers 1, 2, and 3 are all true. Number 4 is false, because it's saying that the lender would only have the personal covenant of the borrower and the value of the property for security, and that's not true, because they would also have that insurance policy as security. And that is the reason why lenders require it, is so that they can rely on that to regain the money, the capital that they've invested by giving that loan to the borrower. Okay, so this one, question 204, is asking you about something that you recognize. Your loan to value ratio. So we know the loan to value ratio is in our M formula that we use when we are trying to figure out how much mortgage monies that the lender would give based on the lending value of the property. So whenever they ask you about one of the terms, one of the things that's in one of your formula, all you should do then is to rearrange to solve for that item to see whether the answer choices match that rearrangement. Okay, so what are the rules for rearranging? Well, the first one is you need to deal with your subtractions and additions. And the second one is that you would be dealing with your multiplications and divisions. So in that order. For this one, there are no subtractions or additions, so we don't have to worry about step number 1. So we move on to step number 2. There is a multiplication in there. So we take that lending value and we kick it over to the other side and change that sign. So you see that when you do that, it actually matches answer choice number 4. It's the face value of the mortgage loan, so M, divided by the lending value of the property, which is your LV. Okay, so that is your true statement, right? This one's correct. The other ones are talking about other rearrangements or other terms that aren't even in the formula. So market value of the mortgage, where did we know that one from? That was from our PIMP questions, right? So that was the PV was the market value of the mortgage, right? And when we had our PIMPO, that was the market value of the offer. So this is referring to something that you find when you do your PIMPO questions. Okay, so they're suggesting that the loan to value ratio is equal to the payment divided by the market value of the mortgage. No, that's false, because the rearrangement tells us that this is the correct representation, just like numbers 2 and 3. It's saying that the loan to value ratio is equal to the net value of the mortgage divided by the actual value of the property. So actual value should be your lending value, but actual value is kind of vague. right? And then again, market value is kind of vague. It should be the lending value if you want it to be a 100% true representation of what that loan to value ratio is. Okay, so don't be confused by when they put all of these kind of weird things in here. They're just trying to be sneaky tricky in order to mislead you into thinking that something else sounds better. If they mention a term that's part of one of your formula, just rearrange it to solve for the term that they're asking about, and then see if this matches any of the answer choices that you would have in your list. And we see that in this case, it does, because answer number 4 is a correct rearrangement. Okay, question 279. I know there's a lot of stuff on the page here. I actually have 2 questions. I have 279 and I have 279 new together. So that's why it looks really busy on the page. So this is, again, another set of questions that they've given you where it's one version of the question and the opposite version of the question. So 279 says, among other factors, the maximum amount that the purchaser of a residential property may borrow is affected by what? And then in 279 new, they changed that to is not affected by. So in the first version of this question, all of the above is the correct answer because the lender is going to look at the purchaser's income, right? And what do we do with that? We use it to find the payment, right? And then once we found that payment, then we use that payment to find our PV. Second one says the lending value of the property. And what do we use for that? What do we do with that? Well, we use that to find our M. And then the lender will also look at the prevailing mortgage interest rates. So what are the current interest rates? And then we would use our payment and the IYR to find our PV amount, right? So what did we say before in the last question? If we lower the IYR, then we will raise the PV, right? If we extend that amortization, then we will also raise that PV, okay? So the lender is going to look at all of these things, a bunch of other things as well, but these are 3 of the list. And when you look at the opposite version of the question, you see that they've got the same answer choices, right? Which are not the answer, because these are the things they will be affected by. They've changed the all of the above to say the interest adjustment period. So the interest adjustment period is the length of time between the date the funds are advanced and the beginning of the first payment period. And this has absolutely nothing to do with how much the borrower can qualify for. Okay, so you don't need to remember this. Unless you're a mortgage student, then you should remember this. But if you're a real estate student, you don't need to remember that. I just figured if I didn't explain it, and you guys would send a ticket asking what it was. So it's not affected by that interest adjustment period. It's affected by the buyer, the property itself, the value of the property, the buyer's income, their credit rating, the current interest rates, what kind of risk they think there is involved in lending to that residential purchaser. All of those kinds of things are going to affect the amount that the purchaser can borrow. Okay, so 347 says, which of the following is not a procedure commonly used by a large institutional lender in order to reduce the risk associated with a particular mortgage loan? So remember we were talking about all of our formula before? So we had our lending values formula and we had both of our payment formulas that we had. So we had the commercial that was NOI divided by DCR, and we had our residential that was our income multiplied by our gross debt service ratio and minus the tax. Okay, so what did we say was a way to reduce the risk, to lower the amount of funds given? Well, if we reduced the loan to value ratio, if we reduce the gross debt service ratio, or if we increase the DCR, that would decrease the M and the payment amounts that we would find using these formulas. So which one is not a procedure? So reduction of the loan to value ratio, yes, that is. Reduction of the gross debt service ratio, yes, it is. But you notice in number 2, it says increase the interest rate charged. So if we increase the interest rate, if we increase that IYR, then that means that the borrower is going to pay more interest dollars, and they're going to be taking longer to pay that mortgage debt back. And so it would affect the amount that the borrower has to pay back for the interest, right? And it might even affect the payment amount depending on how much, right? It might be significant to the payment amount depending on how much interest rate is going to be charged. So that's talking about a renegotiation situation. When the lender is trying to figure out whether they're going to lend to you in the first place, this is the payment that you're allowed to use. So the payment wouldn't change, but the amount of interest dollars would in the initial situation when the loan is being set up. So this one is not a way, because that would probably increase the risk of the default, right? So again, remember, this is for renegotiation, right? This isn't for when you're first setting it up and we're going through this process, but they don't say, they don't specify where we're at. All right, so question 368 looks like it's tricky, but it's not. So it has 2 different things in here that you should recognize. It has the net operating income and it has the payments mentioned. So when you see those 2 things together and it's asking for you to do something with them, in this case, it says to take the NOI and divide it by the payments. So when you look at this, when you write it like this, you see that the only term, the only thing that's left in that formula is the debt coverage ratio. So the debt coverage ratio is, in fact, equal to the NOI divided by the payment. So I'm going to just rewrite this so that it looks the same as mine. When you have a formula like this, you don't have to do the whole complicated process for rearranging it. All you need to do is switch the term, right? We don't solve for the NOI typically for these questions, right? We're given the NOI, so we're going to solve usually for the payment. But if you get a question like this, all you need to know and all you need to remember is that they can switch places, okay? Because one's in the top and one's in the bottom, they can switch places. So you see that the DCR switched into the payment spot and the payment switched into the DCR spot. So this is a correct rearrangement of that formula. It's a little bit more complicated when you do it in actual math terms, but you don't need to know that because this is the only question that you'll get that asks you about that debt coverage ratio formula. So you won't be asked to solve for anything using it. It's asking for the definition of lending value. So this one comes up in a few different chapters. This one you should have seen in your mortgage law chapter as well. So just make sure that you know this definition. So lending value is a long-term conservative estimate of the value of the interest in land pledged as security. So they don't finish this sentence off here, but it's pledged as security for the loan that's given, right? So for the money that's given. So answer number 1 here is trying to suggest that the lending value is equal to the market value, and that's not true. If you look at your formula, there is another term in there, so it's missing the loan to value ratio. If we actually solve for the lending value for this one, then you'll see that that is an incorrect rearrangement. So I want to keep this lending value by itself, so I'm going to take my loan to value ratio and I'm going to move it over to the other side. And it should be M divided by loan to value ratio is equal to the lending value, okay? So the lending value and the market value are not equal. It's not even in that formula to begin with. You might think, oh, market value, lending value is the same thing. It's not, okay? So just whenever they mention a term in the question and they're trying to get you to define it or to identify what it is, just take the formula that it's in and rearrange it so that you get a true representation of what that term means. Okay, it's not an estimate of the mortgage loan a purchaser will be able to obtain because the lending value is not equal to M, okay? That's what they're trying to suggest. The PV and the M are what we find, right, based on our payment formulas and our M formula that we have here. That's what we find. But the lending value and the M are not equal because, again, you have that loan to value ratio term that you need to add into the formula. It's part of that formula, so you can't just chop it off. And it's not equal to 95% of the purchase price. Now, why would they say that? Why would they even suggest that? Because they're trying to get you confused with the fact that there's a 5% minimum that's necessary for your down payment right now. So you have to have a minimum 5% down when you go to purchase a property, and they're hoping that you think that you can just say in all cases that it's equal to 95% of the purchase price. That's not true. Some people have much more than that 5% minimum. Some people might have 20% or 50% or 75%. It just depends on how much money they've saved and what they're purchasing, and maybe if they have equity in another property that they've been paying a mortgage on for a long time. 456 is when borrowers increase their maximum allowable loan by accepting a shorter term and a lower interest rate. What do borrowers have? So they have a situation where they would have an increased degree of risk regarding changes in the interest rates over time. So why is this? Well, because of that shorter term. So if you have a 2-year term as opposed to a 5-year term, after the 2 years, you have to renegotiate. So you have to actually renegotiate that contract, the outstanding balance that you have left. And if rates have actually gone up, if the percentages on mortgage interest rates have gone up, then you're going to have to pay more interest because you only had that 2-year term. If you have a longer term, then you're locked in to that interest rate that you have in your contract for the 5 years, and you don't have to worry about the rates going up until the end of that 5 years. Okay, so number 2 says the security of never having to incur another set of transaction costs. That's not true. You're going to probably need to pay those at the end of the 2 years and at the end of every term length that you have. A decreased degree of risk regarding changes in the interest rate over time. So you see that this is the opposite of answer number 1. So it's incorrect, right? It's an increase in risk for that interest rate to possibly have changed. And then number 4, committed to paying more interest during the shorter term loan than the longer term loan. And this is false. You pay the same interest. You just pay less towards the PV in that shorter amount of time. So it doesn't have any bearing on the interest that you pay. You still pay the same amount within those 2 years as you would within those first 2 years out of the 5-year term. So it makes no difference. Okay, 457 says which of the following statements regarding financial covenants of the mortgager, so the borrower, is false. So what is a financial covenant? It's what are the promises that you've made in the mortgage contract. So all of the things that you've promised to do and promised to pay in this case, because we're talking about the financial covenants. So they're asking which one is false. So numbers 1, 3, and 4 are all true. So 3 main financial obligations of the borrower, in addition to repaying the loan, include the property taxes, the property insurance, and property maintenance. So these are general clauses that you'll find in pretty much every mortgage contract, that the lender will make you say that you promise to pay and do all of these things. Number 3 says the mortgage loan agreement should contain a covenant by the borrower to insure the property against fire and other specified hazards to the full insurable value of the security. So yes, a lot of times the lender will require that you have specific insurance for the property. Usually fire and flood are the basics, but there could be more depending on where the property is located and what it's being used for. Number 4 says the borrower should maintain the property in a manner that will preserve the value of the security in order to reduce the capital risk. So what is the capital risk? That's the lender's risk, right? The capital is the amount of money that the lender has in that property because they've given you that loan. They've given you that money to purchase it. So if you just let the property disintegrate and you don't do anything to upkeep it, then the property isn't going to be worth as much as it should be, and then the bank may not be able to sell. If you default, they may not be able to sell and get all of their capital back. So those are all true, and true. Number 2 is the false statement. That's the correct answer. It says lenders always make the property tax payments for the borrower to ensure that the property taxes do not fall into arrears. So that is definitely a false statement. The lender will account for it, right, for using the PIG minus tax, and the PNOID formula, it already has had those expenses deducted, so that the net operating income already takes that into account. But they don't usually pay it for the borrower. They expect that the borrower will pay it. Now, when you go to purchase certain strata properties, for certain lenders, you actually can have the lender make you pay the property tax up front. Sometimes it can be part of your strata fees. It just depends on the entire lending situation, whether the lender would require that payment up front or whether it would be part of your strata fees. Most of the time, the lender expects that the owner is going to pay it when it comes due in July. Okay, so 575. So this one is kind of one of those other sneaky questions that I was talking about before. So some of the information in this question actually comes from your mortgage law chapter, specifically when we talked about the priorities. So the priorities list. So the priorities list, just to refresh your memory, was about what things that would be charged on title that would have priority over a mortgage if the lender found themselves in a foreclosure situation and they were going to sell the property to try and get back their capital, to try and get back their money. So even though the lender would actually start that foreclosure process and they would be trying to get the court to sell the property to get back their cash, some things that are on title will actually take a priority over a mortgage. So the Builder's Lien Act, so any builder's liens, anything that has to do with a lien for wages that's owed by an employer. So if you have an employee that you owe wages to and your property's been liened under the Employment Standards Act, anything to do with taxes and the government, right? So the Local Government Act and the Community Charter for unpaid property taxes or maybe some other municipal fees that you haven't paid, any claims under the Federal Income Tax Act. So if you haven't paid your income taxes, if you haven't paid into your Canada Pension Plan, or if you've been overpaid for it and you're forced to pay it back, anything to do with employment insurance, so your EI and your Excise Tax Act. So all of those are government related stuff and you can't really dodge those. So they would take priority over any mortgage that had been charged to the title. And then anything to do with workers' compensation and your strata fees. So again, remember from our strata, so this one is actually from another chapter, from your strata chapter. So from our strata chapter, we learned that it is against the law to not pay your strata fees. You have to. So if somebody doesn't pay strata fees, then the strata corporation has the ability to lien the person's title for those unpaid strata fees. And those unpaid strata fees would take priority over the mortgage. Now, what do I mean by taking priority? If there is once the lender goes into the foreclosure and gets the property sold, and let's say there's $350,000 of profit in that property, once the property sells, that $350,000 will be dispersed, so it'll be given out based on this priorities list. So you don't need to know which one of these comes first. You just need to know that all of these would come before the mortgage. So all of these would get paid out, and then whatever is left would go towards the lender to pay back the obligation that the borrower has under that mortgage contract. Okay, so that's a long explanation, but I thought I would take the time to do that because I know that a lot of people have troubles with that from their mortgage law chapter. Okay, so it's asking which of the following statements is or are true. So lenders can decrease their investment risk by requiring borrowers to purchase insurance for the full insurable value of the security. Yeah, that's true. Since taxes have a priority over mortgages against a property, so we see that they do, right? This is our Local Government Act and our Community Charter. So since taxes have a priority over mortgages as charges against a property, many lenders require that a portion of the annual taxes be included in periodic loan payments so that the taxes don't fall into arrears. So remember how I was saying that sometimes the lender could require it, depending on the situation. So some lenders, they've been burned by the government getting priority over their mortgage. So now they just say, you know what, you need to pay a part of your taxes so that I know that you can handle it when the rest of the bill comes due in July. And then number 3 says if a periodic payment is not made by the due date, daily interest can be charged on the amount of the missed payment. Now that's true as well. And I just want to clarify something because I've been asked this a few times. It doesn't mean that if you have a contract rate of J2 equals 4, that 4% will all of a sudden be charged daily. Okay, it's not 4% daily, it's the daily rate that's equivalent to J2 equals 4. So this is a little bit of a yield review for you. What does that mean when I say the daily rate that's equivalent to J2 equals 4? It means that they want you to change this J2 into a J365, and then you chop that J365 into your ID, and this daily rate would be the thing that would be charged daily on any arrears. So missed payments is what that means. Okay, so if you had a J2 equals 4, just for an example, you don't have to be doing this calculation for this question. Just for an example, just for a nice yield review, you would take your J2 equals 4, and do your IMPEPIN to J365. So the J365 would be 3.9607 and a bunch more decimals. And then you would divide that by 365. And daily, this is what the borrower would get charged. So 0.01085% every day would be charged on the amount that they hadn't paid. Okay, so it's not saying that they're going to charge the 4% every single day. They're going to charge the daily equivalent of that J2 equals 4 every single day, which is this guy here. Okay, so question 596, the risk to a mortgagee can be reduced by what? So this is, again, all of the same stuff that we've talked about in our previous questions. So we know that increasing the amortization period actually increases the risk because you're making your borrower pay more interest, and it's taking them a lot longer to pay back your principal. So there's more time that's needed to get back that PV. Reducing the monthly payments. Nope, that would actually cause, again, a longer amount of time needed to pay back that PV. And you wouldn't be getting as much of your interest back per payment either, depending on how that interest and PV split was. Reducing the debt coverage ratio. Nope. If you reduce that debt coverage ratio, it actually increases risk because it'll increase the payment amount that you're allowed to have as the borrower, and then that increased payment would result in that increased PV when we use it to find the PV in our question. Okay, so reducing the loan to value ratio is that way, right? Remember, reducing loan to value ratio, reducing gross debt service ratio, and increasing DCR are all ways to reduce the risk to a lender. So just another sort of additional explanation here, just to show you what happens. Reducing that debt coverage ratio actually increases the risk because it'll increase that payment, which increases the PV. So how would we prove that? Well, with your math. So if you were to find the payment, right, for each of these, and you were to say your NOI was $100 for each, if you have a DCR of 1, it means you're going to be allowed to spend every penny of that income for your payment. Now, this would never happen in real life, right? This is just used as an illustration. Okay, so you're allowed to spend every single penny of that NOI towards your payment. If you reduce the DCR, see what it does to your payment. If you divide that 100 by 0.9, then you get a higher payment amount, which would then result in a higher PV. If you increase the DCR to 1.2 instead of your 1.1, then you see that it reduces your payment, and then that would reduce the PV because you have less payment to purchase the PV with. Okay, so make sure that you know that this DCR is the opposite of the other two, okay? Makes it really easy for you to answer these questions quickly when you know the relationship. 652 says the process used in underwriting income-producing properties is similar to that for residential borrower qualification, except that in underwriting commercial properties, the income from the business is way more important. So the property or the business is way more important than the personal income of the borrower. So the personal income is used in that PIG minus tax formula, and that's your residential formula, right? The commercial formula that we use from that property is our PNOID formula, and it's based on the NOI, the net operating income of the business. Okay, so whether the property is being used as an income-producing property that somebody is renting out to someone else, or whether they're buying it for their business to run their own, stuff on there, then that would also be a situation where the income from the business would be more important. Okay, so the loan-to-value constraint is used in commercial because we use the same formula. The PIG minus tax is used for residential. That's why number 3 is incorrect. And the lender always uses safety margins. That's what they use in all of the formulas that you have. So the DCR, the gross debt service ratio, and that loan to value ratio. So they always put safety margins in and decide what kind of risk they want to actually take when lending to a borrower. 663, so with respect to an insured mortgage loan, so again, we're talking about an insured loan, which of the following statements is false? So the false one is that the CMHC, the Canada Mortgage and Housing Corporation, is the only institution in Canada that provides mortgage loan insurance. And that is false. There is the CMHC as well as 2 other private companies. You don't need to know them by name, but these are the ones. So all 3 of these actually provide mortgage loan insurance to purchasers of property. So not just the CMHC. Most people will go through the CMHC, but It's not 100% necessary. You can use one of the other ones as well. Different situations, right? Different choices. So the other three are true. The other three answers are true, so you need to pay attention to those, right? So in Canadian mortgage loan insurance, the lender pays the insurer a single premium, the cost of which is generally passed on to the borrower. So the lender will actually pay the premium, they'll arrange the insurance, and then the borrower needs to reimburse the lender for that premium. Usually, like we were mentioning in a previous question, usually the borrower will put it onto their mortgage, right? They'll bonus it onto their mortgage amount when they arrange the mortgage contract and the loan. Number 2 says borrowers can add the mortgage loan insurance premium to the mortgage amount. So that's what I just explained. And then number 4 says federally regulated financial institutions require mortgage insurance in order to make loans with loan to value ratios higher than 80%. So this is true. So remember I was saying before that you have a 5% minimum that you need to have as a down payment. So if that were the case, then that would mean you would have a loan to value ratio of 95%. So if it's above 80%, it needs to be insured. It has to be insured. So the federally regulated financial institutions, the banks, some of the other mortgage corporations, that kind of thing, they all have to have that mortgage insurance when they give a loan for a borrower, and it's more than 80%. So 80.1% all the way up to whatever percentage they're willing to take on. The lower you have, the lower the loan to value ratio you have, the more it means you need to come up with a down payment. So if you had a 30% down payment, then that would mean that you had a 70% loan to value ratio, and it wouldn't require insurance for you. You could actually get your mortgage uninsured. You wouldn't have to pay that premium. But anything that's higher than the 80%, anything that has less than a 20% down payment requires that mortgage insurance. So just be careful about how they phrase this. If they're referring to loan to value ratios, it's going to be something that's higher than 80%. If they're referring to when you can have an uninsured mortgage, then it would be a loan to value ratio that's 80% or lower. So question 666 is asking what the purpose of a credit analysis of a mortgagor is. So mortgagor, remember, is the borrower. So this is just simply to ensure that the borrower has the ability and the intention of carrying out what they've promised in the mortgage agreement. So they look at your credit history, they look at whether you've had late payments, they look at whether you've had missed payments, all of that kind of stuff. What other types of loans do you have? Have you been good about paying everything? Are there certain ones that you prioritize over others? All of those kinds of things. So that is what they mean by the intention. Sometimes people have the ability, but they just don't. So the lender wants to make sure that you have the type of character that means when you promise that you're going to do something, that you're going to actually carry through and follow through on that. Okay? They don't do the credit analysis to see if you're worth suing. If they think that you're going to default and they're going to have to sue you, then they just wouldn't lend to you in the first place. Right? That's not what they're trying to plan for. So they're not going to try and see if you're worth suing. It's not to determine a proper interest rate. Remember, we said that the credit analysis is how you interpret the data, but the report and that analysis is just one of many, many things that the lender will use to decide on the interest rate. So it's definitely not the thing that determines the interest rate. So can't be all of the above, because we know that 2 and 3 are not correct. Has to be one only. Okay, 668 says when a borrower is unable to make the mortgage payments in part or in full. This one is a tricky one for a lot of people. It's the simplest answer, and a lot of people just skip that one over. So it could be due to loss of employment. Could be because of a lot of different reasons, right? But that is one of them. The lender isn't going to automatically use legal remedies. They're not going to automatically sue, okay? They're going to try all of those other easier possibilities first. So they would maybe go to the omnibus clause, make the payment for you, and just add it on and charge you interest, right? So there's some other possibilities before they just go ahead and take you to court and try and foreclose. Number 2 says the borrower has the right to automatically adjust payment terms. No, we wish we could. The borrower can't adjust the terms to suit themselves. They can only do what they're allowed to do in the contract. So the contract tells you what you're able to do. If it says you can, adjust payments or skip payments or whatever the case may be, then sure, you can do that. But most mortgage contracts don't have those types of clauses in them, okay? So the borrower can't just decide to change the terms of the contract just because they're having troubles paying. And then the lender cannot grant extra time to pay the deficit amounts. The lender can do whatever it wants to do. So even if it's not provided for in the contract, the lender can choose to give you extra time if they want to, right? They don't want to go into foreclosed situation. They don't want to actually have to go to the court and say, I want to sell this property because this person is late on their payments. They would like to actually just continue to be in that contract with you and to collect those payments once you get back on your feet. So they can. And clauses like the omnibus clause are how that is provided for in the contract. So they can, like I said, they can just make the payments for you from that omnibus clause, and then they can charge you extra interest on that for, the entire time that you're with them. So this one is the easiest answer choice. I know it's kind of silly, but it is one of those simple answers. Hopefully you get this one on your exam because this one would be a good one. Okay, So 922 is asking which one is the false statement. So the false statement for this one is number 3. So the market share of Canadian subprime mortgages is much larger than the US. So the thing that's incorrect in that statement is that the share of Canadian subprime mortgages is actually smaller than the US. So we have a lot smaller population in the US, so that in itself makes a lot of sense when we do the math kind of in our heads. But if you don't know what they're talking about when they say subprime or prime mortgages, then it might make it difficult to answer this question. So let's just go over that really quickly so you know what it is that they're talking about. So prime mortgages, when they say prime mortgages or A mortgages, that's another way that they can describe them. So A mortgages, this is the majority of lending in Canada. So this is the majority of the monies that are given to borrowers. So this is a situation where the borrowers can qualify for the mortgage based on their credit score or their income or both, and it's considered to be an A mortgage because it's less risky that the borrower is going to default, right? The chance is pretty low that the borrower is going to actually default. So in Canada, we tend to be a lot more conservative with making sure that our borrowers can actually make their payments and not get into a situation where they can't. Subprime mortgages, which are also called B mortgages, or non-prime, or near prime, non-conforming, or high-risk mortgages. So all of those are different ways to say subprime, okay? This is the situation where the loan candidate is considered to be a higher risk. So it could be from one or more reasons. So they may have a poor credit rating. They may have a limited credit rating, meaning they don't have a very long history of credit, so that the lender can make a good judgment on it. They may have some income that's non-verifiable. So if they, are self-employed and they happen to collect a lot of cash, that's non-verifiable. A previous consumer proposal. So if they've already applied for mortgages with other lenders or other mortgage brokers, that can affect your ability to borrow. And maybe they've had a bankruptcy and it's kind of recent, or maybe it was significant and there's still records about it. So subprime is where there is some sort of an issue usually that relates to the person that's wanting to borrow the money, okay? So usually when you have a subprime mortgage, they will charge you a higher interest rate on that subprime mortgage because of that increased risk, right? And there's also going to be higher cost with setting up a subprime mortgage, because remember we said that all mortgages have a pretty high degree of administrative work, but for these subprime mortgages, the investigation and the due diligence takes a lot longer because a lot more information needs to be collected and it needs to be gone through pretty thoroughly before the lender will decide to lend to that borrower. Okay, so you're going to have more fees, more costs for the lender involved in the subprime. So that's kind of what's happening with the prime and subprime thing that they're mentioning here. So Canada is a lot more conservative with the way that we do lending and what we require of our borrowers when we're trying to loan them cash. So the Canadian subprime mortgage market is a smaller share than the US has. So that means that all of these other 3 statements are true. So subprime lenders account for risk by charging increased interest rates. Yeah, we know that. And incorporating higher administration and processing fees compared to prime lenders. Yes, that's all true. One of the problems in the US subprime market arose because the subprime boom introduced lending practices that made it easier to obtain loans. So yes, when you're giving out more mortgages to people, even though they don't have a very good credit rating or maybe they don't have a very long credit history, then yeah, one of the problems that we had when lots of people were not able to make their payments is because a lot of subprime loans had been given out to the borrowers, to the owners of those properties. And the Canadian subprime market is subject to less risk than its American counterpart because all high-ratio Canadian mortgages must be secured with mortgage insurance. So this is what we were talking about in the previous question, one of the previous questions, where we said anything that has a loan-to-value ratio that's higher than 80%, it's a requirement from federally regulated lenders. It is a requirement that it have mortgage insurance on it. And so the borrower would pay the premium for that mortgage insurance to benefit the lender, to make sure that the lender could reclaim their capital if the borrower were to default on that mortgage and stop paying. Okay, so I know lots of information there for just one simple little question, but hopefully that information makes sense to you. And even if you didn't know any of this, you probably could get it down to, a 50-50 choice here. So that's your strategy, right? When you see a question that you've never seen before, that's your strategy. Use what you know to knock off 1 or 2 of the answer choices, and then you have a 50-50 chance of getting it right if you're stuck between the last 2 choices.